Brought to you by Prescient Investment Management. Informed by science. Guided by insight. Prescient Investment Management is an authorized FSP.
Welcome to a winter edition of the Honest Money podcast. We're talking about the evolution or the history of investing, especially in more modern times. I guess I shouldn't say the history of investing because that's thousands of years, but the evolution of investing from let's say 100 or plus years ago through to more recent times. And then particularly nowadays, how we're using data and technology to kind of drive investing decisions and the whole investment process. Definitely not my area of expertise. So I'm very glad to have Bastian Teichgreeber, who's the Chief Investment Officer at Prescient Investment Management. Bastian, thanks so much for joining us.
Thanks, Warren, for having me. Pleasure to be here.
So, Bastian, I think it's probably worth just answering the so what question. We're talking about the history of investing, but and for someone listening, they're going to go, why is that relevant? But I think for me certainly, just understanding that the world of investments never stands still. It moves sometimes by the minute. And so doing things the way they've always been done, for example, how they were done 120 years ago, might be good in certain instances. So for example, if you're building pyramids, maybe the way they've always been done, that's not a bad way to do things. But when business evolves, technology evolves, and maybe the way information flows evolves, then I think it's important that we understand the world of investing doesn't stand still, and maybe where it's been and where it's going.
Yeah, that's exactly right, Warren. And it's a good point. We at Prescient obviously strongly push for a systematic investment approach. That's what we do. That's what we've always done for 25 years now. But you're exactly right. So there's more information, ever more information becoming available every day. Buzzwords like big data, AI, machine learning are ever more pronounced. And it's just important to acknowledge that you have to become smarter and smarter to keep up with the information flow and to keep up aiming to have that edge when it comes to managing money. And that's where we at Prescient see ourselves exactly being at the forefront, because we have always been subscribed to a very systematic investment approach.
So Bastian, let's just maybe shoot back a bit. So kind of 100 years ago, we're sitting with very big annual reports, maybe not so thick as they are today, because the compliance people hadn't gone crazy yet. But we had accountants basically writing, annual reports with maybe the CEO putting in a bit of a spiel at the start, and then we would get our prices of shares. Most of us would get them from the newspaper, and the professionals might have got them from a ticker, I guess, in the old days. And then you'd have a bunch of oversized, overfed men standing in the middle of a floor shouting and screaming prices at each other. And someone's got to make an investment decision in that kind of craziness. And I guess that's how it started. That was the original stock exchange way of doing things.
It was pretty much that. But I think what we see, if we go back all the way, let me go just back all the way to the 30s, that there was actually more science than art involved than you would think. So all the way back until the 1930s, we did have the traditional old school method of managing money. That's like the Warren Buffett's becoming big, where they would aim to determine the fair value of a company by using fundamental values, exactly as you put it in the balance sheets. And that method is to some degree still applied today. So like some of our bigger competitors still go down that route, looking into balance sheets, trying to crunch the numbers and get this old school method of managing money going towards working in their favor. It was in the 40s then when we moved to William Sharpe, more risk and return focused, like looking into bringing risk into the perspective. 1950s, we then moved into modern portfolio theory, where we put Harry Markowitz basically won the Nobel Prize for putting together risk and return and correlations in a mean variance framework. And then Farmer French in the 90s introducing risk premia. And nowadays we're talking about big data, AI, and machine learning. So that's kind of like the evolution of the last 100 years, but it has actually been pretty scientific, if we're honest.
So let's just maybe jump around a little bit there, because there's some interesting things that kind of evolved through this time. So one of them was, in the early days, people started out looking for return, and it sounds like an obvious thing. We're just looking for growth. We want to buy things that have the ability to generate growth, but there wasn't as much focus on, if I buy this growth, how much am I prepared to lose? What's the cost on the other side of that growth story? And so, in the early days, it was, today it sounds kind of obvious. Risk and return are related, but that actually wasn't ingrained in the investment world in the early days. It was just about return. Where can I get the most return? And no one wants to lose money. So they wouldn't have quantified getting growth as how much can I lose as well. And I think it is important to understand, when we're making investment decisions, we're not just looking at growth. You can look at Bitcoin and say, well, gee, I can buy Bitcoin at whatever, 2, and it goes to 1,000. That's amazing. But actually, it can go from 2 to 0. And so understanding that, just looking at growth is often a very good way to lose money, and you have to quantify your decisions in terms of the risks that you're taking to achieve that growth. And that wasn't part of the deal in the early days.
No, you're exactly right. I mean, if you go back to the 30s again, Graham and Dodd, discounted cash flow models, that was scientific back in the days. But as you said, Warren, there is no risk featuring here. It's all about understanding, is a company undervalued or is it overvalued? And if it's undervalued, you want to buy it. And that was, that was a discounted cash flow method is still applied today. But you're exactly right. Risk wasn't part of the story. And then it was in the 40s when, William Sharpe, we still use the Sharpe ratio, right? He basically applied a scientific approach to putting risk and return mathematically into context. And exactly that was happening. We just say like 10% expected return is not the same with a 20% risk as it would be with a 5% risk. So if I can 11% or 12 or 15% with no risk, that's awesome. But if I have to go through massive volatility to get there, it's not that great. And so it all evolved in a pretty scientific way, and we find that quite interesting. But you are exactly right. A lot of these things needed to be discovered through time.
So now we kind of accelerate as, I guess, global stock markets get bigger. Just generally the economies grow, and the concept of investing becomes more palatable and more well accepted everywhere. Now we see pension funds buying into shares, and we go into big endowments, and big investment businesses are built, and so the need to scour information, I would say, is maybe the phrase, becomes important, because you can't just read tens of thousands of annual reports and prospectuses and thousands and thousands of newspapers. Firstly, it would take forever for the annual report to get to you from Japan if you're looking at a Japanese company, and secondly, the volume of information that you would have to go through is just too big. So we kind of jump forward to starting to use. I mean, I don't want to say technology, because in the early days, maybe it wasn't so much tech driven as formulaic in a way, where you kind of start to say, well, what can we do to exclude a bunch of businesses that we shouldn't invest in? Whatever our philosophy is, and I guess that's maybe I'm going to steal your thunder a little bit, but that's maybe the early days of systematic investing. It's starting to say, how do we, yes, identify investment opportunities, but start by getting rid of a whole lot of things we don't have to worry about, a whole lot of whether it's shares or bonds or investments that are just not in our universe. They don't suit the way we want to choose our investments.
That's exactly right, and you're also right on the calculation. So that, I think, if I look at it chronologically, we're probably somewhere in the 50s now, where we basically now start to understand, okay, you must exclude stuff potentially for also correlation reasons. Okay, so in the 50s, Harry Markowitz, when he developed modern portfolio theory, he actually he couldn't do these calculations with a calculator. You just were not sufficient. Like, you didn't have a big computer to do the work for you back in the day. So it was a pretty cumbersome exercise to basically work out, you've got, let's call it 10 shares with 10 different risks and 10 different returns, and they all are correlated in different ways towards each other. So putting that together, I mean, he earned a Nobel Prize through that. Nowadays, obviously, exactly as you said, the topic becomes much more complex, because tens of thousands of securities which we could put together in a portfolio in a smart way, and many of them shouldn't feature. But in order to get that, you need to really apply proper math, and you need, as we think, some basic machine learning processes, and you need also the setup to deal with these big data sets. So at present we are going down all the way to have an integrated data science team within our investment team, just because we know the investment theory will continue to evolve. The evolution doesn't stop here, so it becomes ever more demanding to basically keep up with all of that. And for us as a team at Prescient, we are we are subscribed to being on the forefront and staying there, and it's just needed to have a different profile of people and a different set of people to achieve all of this. But so far I think we're doing well in getting there.
So you're talking about correlation, and I think it's worth just explaining that and expanding on it. So when we buy a share in a portfolio, what we're interested in is the risk return profile of that share. So we want to get paid for the risk that we're taking to buy something that could go down, and the way we get paid for it is the potential return. At the same time, we don't want to buy 10 shares that might all be offering value, but actually will all go down at the same time, because they all happen to be affected, let's say, just by interest rates or just by a particular cycle. So we're looking at investments that will go up at different times and maybe down at different times. And the hope there is, this is kind of classic diversification. The hope is that 1 + 1 gets you to 2 1/4.
It's exactly that. So that's exactly what modern portfolio theory says, that if you bake in correlations, you can eliminate risks without actually losing expected returns. And that's the whole trick. But that is a numbers game. Okay, so it's not that's exactly where investing is not an art anymore, but investing becomes a science. So if I combine 3 assets, the one goes up on a Monday and on a Wednesday and on a Friday, and I combine that, and the other days it goes down, and I combine that with an asset which goes up on a Tuesday and a Thursday, I am smoothing my investment out, but they still both together go up at the same pace. But my risk is basically perfectly eliminated. So that's a very simple example, but and a simple example using 2 assets. If I have 2 assets, I can actually really work out how to weigh them to eliminate that risk. But if I'm looking at 10,000 of different assets, there's a lot of different combinations which you can create. And face it, 1 or 2 or 3 or 4 or 5 of these combinations are the smartest combinations. And it's impossible for us to put that together with our human brains. We need a machine to help us there. And that's where basically the science comes into play, and where we can basically create portfolios which are less risky but still yield the same expected return.
So I guess I've got to ask you the hard question, which is, if it's become this scientific and this advanced, why is it that markets still boom and bust?
That is a good question, but there's a couple of reasons for that. The first reason I would mention is that we still have to go through economic cycles, and economic cycles will lead to different results for different asset classes. And we are not looking into perfectly efficient markets yet. So it's not that information is readily available to everybody in the market immediately. Otherwise, we wouldn't have that much of a boom and a bust cycle. And another important thing is obviously behavioral biases. So that's a big thing. That's again a reason why we want to do things systematically, because we as human beings are naturally driven by fear and greed. If markets run, we are easy to become greedier and greedier and greedier. And if markets fall, we are quick to panic. And we eventually even go into like neglecting an investment if it has fallen too much, and we say, whatever, hopefully it will recover one day. So very hard for us as human beings to cut losses, and very easy for us to take profits early. But cutting out emotion and really going with scientific evidence, with all the information you have at hand, that's what we need to do.
So I think the important thing about something like this is that you can refine your investment process, and I think it's important to do, and you can keep building your data sets, but always understanding that there will be an element of luck, whether it's good or bad, that comes into this, because it's impossible, for example, at the moment anyway, to forecast, a weather disaster that could have an impact on grain prices, that then impacts on inflation and starts a whole economic kind of chain from there. Equally, that for now anyway, most investments around the world are still bought and sold by the people sitting in the chair, by human beings that are biological and not machines, and so we are impacted by these emotions, and it could be anything from the way our sports team played on the weekend through to the good or bad president we've got, or great weather. We get impacted by winter and summer and all of those things, and so ultimately, I think it's important for investors to understand that you will always do your best, I think, when you are investing money, and kind of focusing on process and the way you do things is critical, because it means you'll be increasingly right more often than you'll be wrong. But there will always be the element of chance where the best investment decisions end up costing you money because actually just circumstances went against you. Putin invades the Ukraine. That's not going to be in the valuation of a business. That's just going to be an event that comes, and it will have been obvious in hindsight, but not actually obvious to anybody making an investment decision. So I think it's a key thing, when someone's listening to this, to understand the art and science of investing will always be there. You'll try, and someone like you, I guess, will focus on trying to make science bigger impact on investment decisions, so that the ability for humans, the art part of it, to impact negatively will be smaller. But eventually, the best will in the world, if there are 10,000 Bastians working with the biggest computers in the world, they're on the other side of a trade from someone who just had a lousy day and ends up starting a chain of things because they're emotional, not because they're rational. And I think it's a key thing in investing is for as long as human beings are somewhere at the wheel of driving markets, it's never going to be perfect. And that creates the opportunities, actually, I think, still to this day, where if everything's known, there would be no opportunity. The things would be perfectly priced, and finding those price discrepancies is really the key to how you make money over long periods of time, allied to all the other things we've just spoken about.
It's exactly that. So markets are not perfectly efficient, as you said. Otherwise, it would be pretty boring because the opportunity would be gone. But I also want to drill into what you said about luck. So yes, but there is luck and bad luck and good luck. But the reality is also, once you apply a scientific approach, you can understand the extent of which good and bad luck starts to play a role, and you can quantify a whole set of outcomes around your expected outcome. Okay, so you don't have to just have a base case, a bear case, or a bull case. You can draw a whole distribution of outcomes around your expected outcome, and with that, again, you start to systematize and to scientifically back your analysis, and that just yields a lot of benefits. So you mentioned the example of Putin invading the Ukraine. It was impossible to foresee. Well, at least without any significant inside information, it's very hard to foresee that. But it's not the first time that we have an idiosyncratic shock like that. We had invasions or wars in this instance before, and we can see what that has historically had as an impact on capital markets. Is it good for which asset class? Is it bad for which asset class? And if you assign a certain probability to your investment approach to go through certain events at times, you can actually scientifically put together a portfolio which is quite robust and manages to get through these events quite well.
And I think that's the key. Is you're talking about. I always try and kind of visualize things and say this is a bit like the tide. So you can build a ship that will deal with high tide and low tide, and the aim always is to build a ship that's good enough that it never sinks. You never get to the point where when the tide goes out, you never recover. Your investments might go down somewhat, and that's okay, that's normal. But at the same time, that you don't lose so much that you can never recover. You can never bounce back to making money again. And I think for me, that's the kind of holy grail of investing, is understanding that losses will be there, but losses need to be small. And of course, we would like to lose as little as possible, all of us, and potentially never lose money. But I don't think that investment has been invented yet. but understanding that if the dips are small, that the potential to recover is there, and of course you want to recover as soon as possible. Do you think that's a fair assessment?
Yeah, this is 100% a fair assessment, Warren. Nothing to add.
So, Sebastian, now we're in the world where if you've got a fruit manufacturing kind of facility, or not a packaging facility, you want to add AI to your name because that might make your business more valuable. And so we're in the world of everything AI, and it must be a bit frustrating for a business like you where you've been in the data business for a long time, and now all of a sudden. Everyone's just going to go and buy a formula or put an investment theory into algorithm into chat and say, gee, I'm an AI investor now. How do you navigate this?
Not frustrating at all, Warren. That's actually exciting for us because we do think our time is now. And I can tell you it's not as easy as you've just put it. You can't just buy a formula. You need to first understand what formulas are out there and how they serve your investment approach. But once you have the right set of people and you have this dedicated data science team ingrained into your investment team, you actually are on the forefront to reap those benefits which are becoming available. And the interesting thing is you don't even have to buy the formula. The formula is available for free. So everything, not everything, but most of the stuff we use is actually open source, which really means everybody could use it if you just would have the skills. And that's where the crux lies. So unfortunately, we can't just buy a formula to make us money because then everybody would have done that and the benefit that the edge would be gone. So the edge now really lies on who understands best what's out there in terms of new advanced technologies, who out there is able to, basically deal with this ever more information hungry investment approach which we apply. And for that, you need a specific setup. So no frustration on our side. It's exactly the opposite. Our time is now, and we are every day excited about the new opportunities which are becoming available.
So I'm glad that you said you mentioned that, because I think eventually you've just landed back on the art of investing, because you can have big computers and powerful programs, but eventually you need a history of experience, understanding what to choose, what to avoid, and what tools are good and what tools might be destructive, and then how to use them. And eventually that comes down to people. It's a key point, I think, in this whole investment world, is that I don't think anytime soon we will just be outsourcing all investment decisions to really smart programs and computers, because ultimately the judgment of what is best does rely on some human interaction as well. Feels to me like we're getting to kind of like a cyborg world, Bastian, where we need machines and humans to be working together to make better and better decisions. But I don't think the one grouping can do it entirely on its own.
No, I agree with that 100%. I think the cyborg world which we are describing is, like it or not, a quite realistic example. Partly we are already cyborgs. Very often decisions are smarter made by using tools like ChatGPT. So integrating the technology out there with us as human beings into our decision making, that is absolutely key. But for that, you also need the right investment philosophy. So it comes down to the people, exactly as you put it, but also comes down to your philosophy. You need to have a philosophy which allows for innovation and which strives to be on the forefront of using technology. If you don't have that, and if you don't want to ever deviate from your old potentially outdated traditional value investing approach, like Graham and Dodd did it in the 30s. There's nothing wrong with value investing, but you need to adapt, and you need to move forward, and you need to acknowledge and understand that there's new tools becoming available, and you must never stray away from your philosophy. Always stay true to what you've been doing. But I guess at the same point in time, never stop innovating, because at that point in time you will inevitably fall behind quite dramatically. And in our world of investing, where everything becomes ever more efficient, if you fall behind, it means negative alpha, it means negative returns. So you really want to stay ahead of the curve, and that's what we're striving for every day at Prescient.
I think that's a perfect place to end it. We're way over time already, Bastian. Thank you so much for your time. It's been a real pleasure having you on the show. Talking about cyborgs and the like allows me to say I'm going to end the show and I'll be back. Thank you so much.
Brought to you by Prescient Investment Management. Informed by science, guided by insight. Prescient Investment Management is an authorized FSP.